If a leaked number is real, 25,000 tons of gold, then the modern financial world isn't just mispriced, it is mismeasured. 25,000 tons is not a rounding error. It is not a modest revision. It is a mass of metal so large that it starts colliding with the scale of official reserve. Reporting, bullion banking, and the idea that price discovery is happening in one unified global market. Here's the compression that matters. Not months, not weeks. In 48 hours, a single narrative like this can shift how counterparties treat each other. It can change margin decisions. It can change delivery preferences. It can change whether a promise is accepted as cash equivalent or treated as a risk that must be collateralized. And here's the impossibility claim embedded inside the rumor itself. They said the system is transparent enough that a discrepancy of that magnitude could never exist. They said official reserves are tracked, audited, and broadly understood. They said gold is a legacy asset, an inert relic, a shiny distraction from yield-bearing instruments. That story works right up until the day a number appears that is too big to ignore. Because if institutions believe even a fraction of it, they don't need a press conference. They simply adjust behavior. They demand more collateral. They shorten settlement windows. They reroute flows. And the public doesn't see it, because the public is still debating whether the leak is real, while the plumbing is already being tightened behind closed doors. What I'm about to reveal is not a prediction. It's a map of stress points. A way to look at hard numbers already sitting in plain sight and understand why a claim like 25,000 tons doesn't matter as a headline. It matters as a lever. It pressures trust. It pressures delivery. It pressures the difference between reported metal and deliverable metal. Welcome to Vault Line. This is where we decode what matters before it becomes dinner table chatter. We focus on the mechanics, the dislocations, the quiet institutional moves, and the historical patterns that repeat when confidence starts slipping. If you've been here before, you know the drill. Listen, like you're hearing an older trader explain the rules nobody writes down. And if you're new, drop a quick comment saying where you're watching from, because this story looks different depending on which side of the world your prices, your headlines, and your assumptions come from. Now, let's state the core event with forensic clarity. The leak is not an official document that everyone agrees on. It is a viral claim that is circulated through gold commentary, that China's true gold holdings could be around 25,000 tons, far beyond the roughly 306 tons it has reported publicly in recent official updates. The claim typically arrives wrapped in a broader argument that a large portion of China AS gold is held outside the central bank's reported line item, distributed across state institutions, policy banks, sovereign vehicles, or strategic reserves that don't get labeled in the way Western audiences expect. On its face, the number is extreme. It would be larger than the official reserves of most nations combined. It would dwarf the gold holdings of many major economies. And it would imply that the global map of monetary power has already changed, while public reporting is still using an outdated legend. But here's where it gets interesting. You don't need to prove 25,000 tons to see the pressure building. You only need to observe that the gold market is already behaving as if official narratives are incomplete. Start with central banks. The official net purchases for 2025 were 863 tons, with a surge in the fourth quarter. That's lower than the plus 1,000 ton pace seen in the prior 3 years, but it remains far above the 2010 to 2021 annual average of roughly 473 tons. The largest reported buyer for the second year running was the National Bank of Poland, adding 102 tons in 2025. When a country buys triple digits of tons in a single year, it isn't collecting souvenirs. It's shifting the architecture of its reserves. Now, layer on a second lens. By the end of December 2025, the amount of gold held in London vaults stood at 9,106 tons, $261 trillion, and equated to roughly 728,512 gold bars. London remains a core node in the global bullion system, and that vault figure includes commercial vaults and the Bank of England's holdings in the London ecosystem. 9,106 tons sitting in London is not a small number. It is a pool that supports an enormous amount of paper trading, leasing, swapping, collateral, operations, and price discovery mechanisms that extend far beyond the physical bars stacked in those vaults. And then you get to the dislocation that makes everyone uncomfortable. 31 Wen per gram. Convert that into dollars per ounce using the day's exchange rate and the grams per ounce conversion, and it implied a price north of $5,000 an ounce, while US pricing that same day was in the high 4,000s. That gap works out to a premium in the high single digits, roughly 8%, between Shanghai's physical benchmark and Western screen prices. That is not a normal market, not when the asset is supposed to be globally fungible, not when arbitrage is supposed to close gaps. A persistent premium tells you one thing: the barrier is not information. It is friction, it is controls, it is settlement preferences, It is different pools of metal being treated as different assets. This is the central mystery. If gold is one market, why does the same ounce price differently depending on where it must be delivered? Now, before we move forward, we need the historical pattern, because gold doesn't just move on stories. Gold moves when the rules of credit are questioned. In 1933, the United States faced a banking crisis, and the response was a restructuring of how gold could be held and used domestically. The result was not merely price movement, it was a change in the relationship between citizens, banks, and the state's monetary anchor. In 1971, the convertibility link between dollars and gold was severed. The result wasn't a mild adjustment. It was an era shift. The price of gold was freed, currency regimes changed, and the world moved into a system where trust in sovereign currency was no longer anchored by redemption. Then, in 1998, a different kind of stress appeared. A highly leveraged hedge fund failure rippled through markets, and suddenly the value of collateral and the reliability of counterparties became the story. Gold's role in that era wasn't about coins and drawers. It was about how the system hedged credit risk and liquidity risk when shocks moved faster than policy responses. Here's the repeating structure. In 1933, the rules changed. Result, the monetary anchor became centrally controlled. In 1971, the rules changed. Result, fiat regimes expanded and gold repriced into a new order. In 1998, leverage exposed fragility. Result, liquidity preference surged and the plumbing was reinforced. And in 2026, the pattern is not a single headline. It's the combination of central bank buying, visible vault inventories, and the recurring premium in markets where physical delivery is the point of the trade. Now we bring in the players because the market doesn't move on abstract forces. It moves through institutions. At the center of the Western pricing mechanism are large futures exchanges and the over-the-counter bullion market centered on London. Futures contracts give immense liquidity, but liquidity is not the same thing as deliverability. The futures price is a promise of cash settlement or delivery under a rulebook with margin requirements that can change. The over-the-counter market is where swaps, leases, and forward agreements allow gold to be used as collateral and liquidity. In that world, a vault isn't just a warehouse. It is part of a balance sheet. Bars can be allocated, unallocated, pledged, leased, swapped, rehypothecated. Two parties can reference gold and mean very different things. A specific bar with a serial number or a claim on a pool. Meanwhile, in the East, the gold narrative is often closer to physical settlement. The Shanghai benchmark is explicitly tied to physical lots, and the pricing process reflects supply and demand in a system where delivery matters in a more direct way, and where the ability to move metal across borders is not frictionless. Add to that the presence of central banks and state actors. Central banks can buy gold quietly, report later, report partially, or hold through entities that don't show up in the line item most people watch. This is why the 25,000 tons claim is so potent. It suggests a world where the visible number is not the controlling number. And markets are extremely sensitive to that possibility because markets run on the assumption that the visible numbers are at least directionally honest. Look again at 2025's central bank buying, 863 tons. That is not retail, that is official demand. And when Poland adds 102 tons in 1 year and communicates longer-term targets for its gold holdings, it is telling you something without saying it, that reserve composition matters more than it used to. Now consider the broader context central banks have been navigating since 2022, when financial sanctions and reserve freezes reminded every capital city that reserves are not just an accounting entry, they are a tool of sovereignty. Gold is attractive in that world because it is an asset without someone else's signature on it. To understand why the number detonates attention, you have to translate tons into time. Global mine production in a typical year is measured in the low thousands of tons, not tens of thousands. So when someone says 25,000 tons, they're effectively claiming control over an amount of new supply equivalent to multiple years of global mining, concentrated into one strategic stockpile. Even if you assume the metal was accumulated over decades, the implication is the same. A reserve position that large becomes a gravitational force. Now, compare that scale with the world of official reserves as it's usually discussed. In recent years, central banks collectively have been reported to hold on the order of mid-30,000 tons of gold. That matters because it means a 25,000-ton hoard would represent a shockingly large share of what the official system admits exists in official hands. It would also mean the ranking narrative. Who has the most, who sits behind the United States, who has real monetary weight, could be radically different than the public scoreboard. There's another contradiction that shows up in mainstream institutional research. Some official sector commentary has pointed out that gold's share of global reserves has been rising even as the share of certain major currencies has slipped. In that framing, gold is no longer the antique asset sitting quietly in the corner. It is being treated, increasingly, as a strategic reserve asset again, liquid, sanction-resistant, and politically neutral in a way that foreign government bonds are not. The logic is uncomfortable, but simple. If reserves can be frozen, then reserves need to include something that can't be frozen as easily. And then you see the expert contradictions. One camp argues that the gold market is too deep for any single actor to matter, that futures liquidity proves the system is robust, and that price is the ultimate truth. Another camp points to persistent regional premiums, to the complexity of bar standards and vault chains, and to the way central bank reporting lags reality. Both camps can sound confident, and both can be partially right, but their conclusions are incompatible. If price is the ultimate truth, premiums should vanish. If deliverability is the ultimate truth, screen liquidity can be an illusion in stress. This is why the leak lives longer than it should. It sits inside a real debate, whether the world is still operating under a single, unified liquidity regime, or whether it is sliding into a world where the same asset trades like two different goods, depending on jurisdiction and delivery rules. And if you want one more data-shaped clue, look at how often analysts discuss unreported or on off-balance sheet accumulation as a possibility. Reports circulate alleging that official purchase lines understate total buying by multiples in some cases, pointing to trade flows and domestic accumulation that do not neatly reconcile with reported reserve changes. That does not prove a 25,000-ton figure. But it does show that the idea of hidden accumulation is not purely a fringe concept. It exists because gaps between flows and disclosures can be observed, even if the true explanation remains contested. This is the part no one is discussing enough. Gold demand is not just about inflation fears or jewelry. It is about sanctions risk management, settlement optionality, and the ability to move value across regimes that do not always get along. Now, let's put the dislocation on the table in the most honest way possible. In the West, the paper market says gold is liquid, tight spreads, massive volume, instant pricing. Those two stories cannot both be stable forever. If the West's paper liquidity is the truest price, then the premium should vanish quickly because arbitrage would flood the higher-priced market with supply. If the East's physical price reflects scarcity or constrained deliverability, then the Western price is a reflection of paper abundance rather than metal abundance. A persistent premium is a signal. It tells you that something is stopping the normal balancing mechanism. Maybe it's capital controls, maybe it's shipping constraints, maybe it's refineries and bar standards, maybe it's policy. But whatever it is, the gap exists, and it is quantifiable. And the most important thing about a quantifiable gap is that it creates a stress test. The larger the gap, the more pressure builds on the idea that gold is gold everywhere. Now, let's move into evidence, because the market is full of opinions, but the system breaks on numbers. 31 yuan per gram on January 30th, 2026. That's a physical auction benchmark, not just a screen quote. It is a price formed where orders are matched for physical lots. When that benchmark implies a several $100 per ounce premium versus Western pricing, the data is not whispering, it is talking. $261 trillion, roughly 728,512 bars. That is a massive stockpile, but it is also a finite pool supporting a very large derivative ecosystem. The more stress rises, the more market participants care about how much of that pool is truly available, how much is pledged, and what delivery really means in a pinch. Evidence point 3 is central bank buying. 863 tons in 2025, with 230 tons in the fourth quarter alone, and Poland adding 102 tons. Central banks do not chase memes. They respond to structural incentives and risks. Now, where does the 25,000-ton claim plug in? It plugs in at the level of credibility. If a large player can credibly be believed to possess far more gold than reported, it changes negotiation dynamics in trade settlement, currency swaps, bilateral agreements, and even in the psychology of other reserve managers. It can also change expectations about future monetary arrangements, even if no new arrangement is announced. But we have to be disciplined. The claim is not proven in public. The point is not to treat it as gospel. The point is to see why a market already displaying premiums, official buying, and physical versus paper tension becomes fragile when a rumor adds one more layer of uncertainty. Now let's talk mechanism, because everything breaks sounds dramatic until you see how it actually happens. The first lever is margin. In paper markets, a small change in required collateral can force selling or forced position reductions. When volatility rises, exchanges and brokers protect themselves. They raise margin. That doesn't have to be malicious. It's risk management. But the effect is the same. Leveraged players get squeezed. They liquidate what they can, not what they want. The second lever is settlement preference. When counterparties begin to worry, they ask for different terms, shorter settlement windows, higher quality collateral, more cash, more allocated metal, less reliance on unallocated claims. The third lever is logistics. Gold is not a digital token. Bars have standards. Some markets demand certain bar sizes. Refineries have capacity constraints. Shipping has insurance, security, timing, and regulatory friction. When a premium opens, it is not always trivial to exploit it, because the metal you have may not be the metal the other market will accept without transformation. Think of it like a fire code in a crowded theater, and the paper promises get questioned. Everyone can sit comfortably when the lights are on and nothing is happening. But in smoke, the width of the exits becomes the entire story. The market can quote liquidity on screens all day. In stress, the exit width is physical deliverability. This is how an unverified claim can still matter. Now we go forward, but carefully. Historically, when these patterns intensify, official demand rising, physical premiums appearing, and trust in reporting becoming a topic, the outcomes cluster into a few recognizable scenarios. Scenario 1 is conservative. The premium compresses as policy loosens, logistics normalize, and Western price discovery remains dominant. In that case, the story becomes a footnote and the system absorbs the tension without a regime shift. Scenario 2 is moderate. The premium persists intermittently, and more market participants begin to pay for quality in the form of allocated metal, specific bars, specific vaults, and settlement options. In that world, the quoted price remains, but the real price becomes a spectrum, depending on location and deliverability. Scenario 3 is aggressive. Stress events force a visible repricing of settlement risk. That could look like sudden spreads, sudden changes in contract terms, sudden divergence between paper and physical, and a scramble for the most trusted form of collateral. It's that the rules for what counts as money-like collateral become tighter. Notice what is missing here. There is no guaranteed outcome. There is only a pattern and a range of historical behaviors. So what should be watched? Not rumors, not viral posts. Watch measurable indicators. Watch the Shanghai benchmark relative to Western prices. Watch official central bank purchase reports and the cadence of accumulation. Watch changes in vault holdings and where inventories concentrate. Watch policy changes that affect imports, exports, and settlement. Because that is the hallmark of a system moving from frictionless finance back toward physical constraints. Now we end with the divide, because this is ultimately about attention, not genius. There are people who treat gold as a chart and nothing more. They see it as a line that rises and falls, a speculative instrument, a headline topic. And then there are people who see gold as an instrument of settlement, sovereignty, and collateral, an asset that matters most when the trust level in paper promises starts to slip. The gap between those two perspectives is not academic. It becomes a wealth gap in the real world because institutions move first. They adjust collateral, they secure optionality, they diversify reserves, they negotiate from strength. Retail arrives later, after the story is obvious, after the terms have changed, after the premium is already priced in. That's why a claim like 25,000 tons is not interesting as gossip. It is interesting as a stress amplifier. It forces the question, what else is being priced quietly that the public still assumes is stable? This is Vault Line, where we decode what matters before its headlines. If this connected dots you hadn't put together, central bank buying, London vault totals, Shanghai's premium, and the way trust breaks long before price does, you know what to do. The question isn't whether the system can handle another rumor. The question is whether the next tightening of the exits happens before most people realize they're in a crowded theater.